Everyone says this. When there are more buyers than sellers, price goes up. Sounds logical, right? But what if I told you? This is completely wrong. In fact, this one misunderstanding is why most traders lose money. Because the market doesn't move based on more buyers or sellers. It moves based on something far deeper, imbalance and liquidity. Today, we're breaking the biggest myth in trading. Section 1. The popular belief, the lie everyone repeats. You've heard it everywhere. YouTube, books, even so-called experts. Price rises because buyers are stronger than sellers. But here's the problem. For every buyer, there must be a seller. Every trade has two sides. If you buy, someone else is selling to you. So how can there ever be more buyers than sellers? It's mathematically impossible. Section 2. The truth. Transactions are always equal. Think of the market like this. Every executed trade equals one buyer plus one seller. No exception. If 1,000 contracts are bought, 1,000 contracts are also sold. So price doesn't move because of more buyers. It moves because of who is more aggressive. Section 3. Aggression moves the market. There are two types of participants. Passive limit orders. Aggressive market orders. Price moves when aggressive traders step in. Example. If buyers are willing to pay higher prices instantly, market buy. They lift the price up. Not because there are more buyers, but because buyers are more aggressive than sellers. Section 4. Liquidity, the real driver. The market runs on one thing. Liquidity. Big players don't care about buy versus sell. They care about where liquidity exists. Liquidity equals where stop losses and orders are sitting. Above highs buy stops. Below low sell stops. Smart money moves price toward liquidity. Not because of demand, but to fill large orders. Section 5. Imbalance is the real law. The real law is not supply versus demand. It's imbalance. When there is an imbalance between aggressive orders, available liquidity, price must move to restore balance. This is why you see strong impulsive moves, sudden spikes, breakouts, not because of more buyers, but because of lack of opposing liquidity. Section 6. Why retail traders get trapped. Retail traders think, price is going up, buyers are in control, I should buy. But in reality, price often moves up too. Trigger stop losses. Induce breakout traders. Create liquidity for big sellers. So when you buy, you're actually providing liquidity to smart money. Section 7. The trap mechanism. Here's how the trap works. Price approaches resistance. Retail expects breakout. Traders start buying. Stops build below. Then, big players push price slightly higher. Trigger breakout entries. And suddenly, price reverses hard. Why? Because that move wasn't demand. It was liquidity engineering. Section 8. What actually moves price? Let's simplify everything. Price moves when aggressive orders overwhelm liquidity, or liquidity disappears on one side. That's it. Not buyers versus sellers, but order flow imbalance. Section 9. The smart trader mindset. Stop thinking like this. Who is stronger? Start thinking like this. Where is liquidity? Ask yourself. Where are stop losses clustered? Where will retail traders enter? Where can institutions fill positions? That's where price is going. Section 10. The real edge. Your edge is not indicators. Your edge is not signals. Your edge is understanding. Backhand index pointing right price is engineered. Backhand index pointing right liquidity is targeted. Backhand index pointing right imbalance drives movement. Once you see this, you stop chasing price and start anticipating it. So next time someone tells you, more buyers than sellers move the market, you'll know the truth. The market doesn't move on opinions. It moves on liquidity and imbalance. And once you understand that, you're no longer the prey. You start thinking like the predator.